Hey, Kevin here, top one financial advisor and best-selling author, and we are here to talk about the stock market. Today I want to answer a question that someone asked, I think it was on Instagram, it might have been on public, one of those two, which again, when you ask great questions, I get to come up with great videos. And this question was, why is it bad? Actually, it was from Instagram. I remember now. They DM'd me on Instagram this question, and I answered. So here we are in video format to answer that question again for everybody else, because it's not the first time I've heard this particular question. The question is, why is it bad for me to wait for the market to drop for me to get in? Because some people say, well, yeah, I want to invest. Let me just wait until the market drops. I'm going to hop in then because, buy low, sell high. That's what a lot of people think is the best process. Here are a few reasons why that may not be the best thing and why it's a little more difficult in practice than what people think it is just on paper. So number one, my process is always be investing, because those who are consistent, when you're dollar cost averaging, which is what I do every Friday, I have no logic as to why it's on Friday. It could be on Monday. It doesn't really matter. My whole thing is be regular. Once a month, twice a week, when you get paid, whatever day you want to do it, you do want to be consistent, because you don't know in what direction the stock market is going to go. We do know, though, over time, 1 year, 2 years, 5 years, what have you, the market tends to go up. That is a fact. That is something that is not in dispute. We know this. So you waiting for the market to fall makes it a lot more difficult for you to figure out what time to get in. And people who say that I'm just going to wait until the market falls, the problem is, fall at what level? At what price level, at what percent drop do you feel like is the best time to get in? Because we just went through a rough September where the market was dropping and dropping and dropping. And if you didn't get in then, when were you going to get in? Last year, when the market dropped 37, 38% between March and April, that would have been a perfect time. Now, if I knew that was going to be the bottom of the market, I would have pushed all my money in the chips on the table and invested in and been really, really rich. The problem is, though, at the time, we didn't know when we were going to hit the bottom. So what I said then, what I'm saying now is, it was March 1, put money in there. Next week, put more money in there and slowly kind of invest at these different levels and average out at a very good price, which is why the majority of my investments have been profitable, and is a process that we know works. But the other thing is, when you're waiting for the market to drop to what I call a magical price level, the problem is anytime the market drops to a different level, then it's basically the exact same price it was at a certain point in the past. For example, I'm recording this on October 18th, okay? And right now, because from the chart I'm looking at SPY. So this is an index fund that tracks the S&P 500. Right now, it is $447.20, okay? So I'll post a graphic somewhere in one of these areas. But right now, again, at the time I'm recording it, it's $447.20. Here's the issue. If this were like the market dropped, the market was up today, let me double check. Yes, the market was up today. If I go back a year, right, I can scroll back to, let's say September 24th. So if I go back, if I'm looking at any chart, I can go back to September 24th, and the price then was $443, right around the same price. You didn't get it then, right? Like, why wait? You could have got it at 443 and rolled it up a bit if this was like that magical price level. I could also go all the way back to about August 24th. I'm sorry, actually on August 25th, it was exactly $447.28. Again, same price level. This is 3 opportunities for the market to quote unquote drop, or for the price to be cheaper that you could have gotten in. And again, you didn't know that, right? You didn't know that was the price you should have gotten in, which makes it more difficult. If I were to go all the way back to December 30th of 2020, okay, December 30th of 2020, this same investment, which tracks the overall performance of the stock market, was at $368.39. Again, way cheaper for you to have gotten it in the past. The problem is, you didn't know what was cheap, right? You didn't know what was going to be the perfect drop point for you to get in and invest. That's the problem. A great example of my own personal story that I've been talking about for a while, that I'm still kicking myself about, is Amazon. Now, Amazon this year hadn't been all that great, but back when the stock was like $1,500 a share, I was thinking that's way too expensive. Amazon is never going to get to $1,000. I'm sorry, Amazon's never going to get to $2,000. Well, it did, and it was still cheap. Because now Amazon is above 3,000, and let me get you the exact price real quick to further drive home my stupidity on not investing at the time that I could have. So right now, Amazon is basically more than $3,400 a share, $3,446.74. Again, what the price is now ain't gonna be the price in 5 years. Not gonna be the price in a year, usually. And because we know the stock market consistently goes up, if you get it now, a year from now, it should be higher. If you get now, 5 years from now, it should be way higher. We know this, and we've measured this and gauged this. So you trying to wait until it drops, number one, most people who say that don't really know at what price they're waiting on. And you don't know how long you're going to be waiting on that price either. I've had clients back in 2011, 2010 say, look, I'm going to wait till the market drops until I get back in. Well, we didn't really see a drop from 2011 up until 2020 with the coronavirus pandemic when it dropped 38%. So you're going to wait from 2011 to 2020, 9 years of growth that you could have had, that you missed out on, just to get in at that point. And then at that point when it happens, you don't know where the bottom is. So you're like, well, I won't wait till it hits the bottom. I'll wait till it hits the bottom. I'll wait till it hits the bottom. It hits the bottom. You don't know that. And it starts to creep up. And it's like, oh, I'm going to wait till it drops again. And it doesn't. Right? That's the issue with trying to wait until it drops to jump in. The best process, because none of us can tell the future, myself included, but what we do know is, again, generally stocks continue to climb. So what you get in now is going to be one of, not the cheapest price ever, but one of the cheapest prices, especially if you're holding for the long term. The only time that I think it matters is if you're trading, which means you are crunching that timeline and you're saying, 2 weeks, 5 months, whatever, I'm really crushing this timeline and trying to be very, very, very precise, which most investors aren't great at doing. I'm gonna just be honest with you. Most aren't. We already know that active fund managers, people who get paid to pick all of these investments and put them into ETFs and things like that, they ain't all that good. That's a fact. Okay. So your process should be to invest on a regular basis, whether it's index funds, whether it's stocks, whatever it is you want to do, slowly build up over time. Yes, you can make more money by putting everything, a lump sum in at one time. Problem is, what time are you going to do that? That's a little bit difficult to pull off, right? However, if you are consistent in putting in money on a regular basis, that is going to be the best thing for you. So I'm gonna give you one last personal example before I end this video. I did an investor call, which I do with my students every single month inside the Investors Toolkit. I'll put that link below. You should really check it out. We meet every month and we talk about what's going on in the market, what I think is happening in the market, and where you might want to consider to do your research. I give you 8 modules and 2 bonus modules. 7 modules with 2 bonuses about how to start investing, how to identify stocks, all that stuff we cover. Again, I'll put that link below. And it comes with, if you do the bonus, it comes with me every month. We sit down as a group and talk about the market. So all that aside, someone asked me about Ford and GM. Now, y'all know I invested in Ford. I'm gonna actually pull up my chart here. I'll put a chart on the screen too. Let me pull it up so that I can be as accurate as possible. So y'all know I invested in Ford back in June. And in June, Ford was trading at like $14 to $15, which at the time, I didn't know that was gonna be the top of the market, right? Didn't know that. However, Ford started to drop, and about August or so, it was about $12 to $13. So I invested at 15, dropped down to $12 or $13. Now, again, because we can't tell the future, you only know what you know at that point in time. And I was losing money on Ford. However, I would have lost more money if I just put everything in June and then just didn't DCA, didn't dollar cost average. But what I did was slowly add more every week. And if you are on public, you saw me do this, you have the receipts, okay? You got the receipts from the date, the money I put in there, and what the current gain is right now. So you've seen me do this. And every single week, adding more, because I didn't know what was gonna be the bottom. I didn't know what was gonna be the top. So because of that, as the stock approached $12 a share, $13 a share, I started to get more shares and more value for the same amount of money that I was putting into the stock, which helped me to buy low by default. That's where you always be buying, right? Because now it's low, or then it was low, but now it's higher. So right now, as we can see, the stock is back up at $15.56 a share, and I'm up about 5.75% as of today. Now, that's not the greatest gain in the world. However, it is a gain. And that is the most important thing, because if I put everything in June, I would have got it at 14 or so, dropped, lost a lot of money. Actually, what was the price again in June? So the highest it was in June, about June 4th, was about $15.99. So it is still not at $15.99 from June 4th. So I still would have lost money. But the only reason I'm positive and making a little bit of money from it is because I was dollar cost averaging. And when the stock kind of bottomed out, which again, we didn't know that was the bottom. We were talking about what was going on in the summer. We were talking about infrastructure stocks. We didn't know, right? We cannot predict the future. So when I was solely dollar cost averaging, I was getting really, really cheap shares in comparison to where they are today. Now it's back above $15. Those shares that were at $12, $13, $14 are now more profitable than the ones I had in June. That is the beauty of doing this particular types of system. However, if I waited, right, if I knew the future and I waited, then I probably would have waited until it hit that $12 share. Here's the problem. Back when it hit that $12 a share, who knew that we were going to bottom out there? Nobody did, right? That's the problem. Nobody did. If it dropped down to 12, I'm going to say, well, I'm going to wait till it hits 10. Then it never hits 10, and now it's back up at 15. That's what happens. So I missed out on my little 5%, or I missed out on the entire run. That's the problem when you say, I'm going to sit back and wait, because you really don't have a price point. And even if you did, it might not hit that price point. So instead of getting at 12, right into 15, and hopefully Ford continues to take off, which we don't know, right? We hope, but we don't know, then you miss out on it. You missed out on Ford, you missed out on the index funds, you missed out on all of that because you didn't know what price you were going to get into. You just said you were going to wait for it to drop, even though it dropped. That same price level that it dropped to was where it was a year ago. The same price level that it dropped to, or the same price it is now, was an opportunity, right? 6 months ago, but you missed it. We know that generally the stock market continues to rise. So you getting in now is going to be the best thing for you. So last thing I'm gonna say is a quote that I have been saying for what I feel like has been years. It probably has been. And that is, 5 years from now, you're gonna wish you started today, right? Like that's the process, right? You know, when I could have invested in Amazon, I did a video on that one a long time ago. It's up there somewhere, probably on Facebook, but I wish I had invested in Amazon $1,500 a share when I thought it was too expensive. I didn't. I missed it. I am not going to get another opportunity, most likely, to get Amazon at $1,500 a share. Okay, that was my opportunity. This is yours, right? When you start now and you're investing on a consistent basis, 5 years from now, you're gonna be like, oh man, that was a great decision. Those who are waiting, those who said, nah, I don't want to do it, I'm gonna wait until it drops again. You could be waiting 5-10 years for this. You never know, right? But those who are investing now are the ones who are going to be profitable. All right, that is it for me. I'll talk to you guys later. I'll put the link for the course in the description, buildingbread.com/tools. Make sure you're on the email list and all of those things. Like and subscribe as well. And that'll be it for me. All right, talk to you guys later. Bye.